What's going on, everybody? This is Chris from Project Option, and in this video we're going to talk about option strike prices. So if you watched some of the earlier videos in the basics section, you probably have a basic idea of what a strike price represents, but in this video we're going to get a lot more specific, and we're going to look at strike prices from the call and put perspective. So first things first, a strike price is the price in which an option buyer can purchase or sell 100 shares if they exercise the option. Now only the option buyer can exercise the option. So let's say you have a call with a strike price of 110. If the call buyer exercises that option, they'll buy 100 shares of stock for $110 per share. Now let's say you have someone who owns the 110 put. If that person exercises the 110 put, they will sell 100 shares at $110 per share. Now let's say you have a strike price of 125. A person who owns the 125 call will buy 100 shares of stock for $125 per share when they exercise the option. A person who owns the 125 put will sell 100 shares at $125 per share when they exercise that put. Now, for every option buyer, there has to be an option seller. So the person who sells the option and is short the option has the obligation to fulfill the opposite position as the buyer. So for example, let's say we have a call option with a strike price of 125. If the call buyer exercises, they'll buy 100 shares at $125 per share. But a person who is short the 125 call will have the obligation to sell 100 shares at $125 per share if they're assigned on that option. In terms of puts, let's say we have a 125 put. If the put buyer exercises, they'll sell 100 shares at $125 per share. But the person who sold that put and is short that put will have to buy 100 shares at $125 per share if they're assigned on that short option. Alright, let's move on. So there are three terms that you need to become familiar with when you're starting to trade options. And those three terms are in the money, at the money, and out of the money. All these terms mean are what is the relationship between the current stock price and an option. So, for example, the term in the money is when a call has a strike price that is less than the stock price, or when a put has a strike price that's greater than the stock price. At the money means that the strike price of a call or put is equal to or near the current stock price. Out of the money means the strike price of a call is greater than the stock price, and for a put, the strike price is below the stock price. Now that you know the basic definitions of those terms, let's go ahead and apply those terms to a hypothetical option chain. So in this table, let's say the stock price is trading for $150, and we're looking at options with strike prices of 100, 125, 150, 175, and 200. If we focus on the call section, we can see that the calls are in the money when their strike prices are below the current stock price of 150, and they're out of the money when the strike price is above the stock price of 150. For puts, the options are out of the money when the strike price is below the current stock price of 150, and they're in the money when the strike price is above the current stock price of 150. Now for both calls and puts, they're considered at the money when the strike price is equal to or near the stock price of 150. So let's talk about how you can make sense of these terms intuitively. So in the money basically means there's value to buying or selling shares at the option strike price as opposed to buying or selling shares at the current market price. So call options are in the money when you can buy shares for a lower price than they're currently trading for, which means the call's strike price is below the stock price. So if we look at the 125 and 100 call in this example, they're in the money because there's value to buying shares at $125 or $100 per share as opposed to buying stock at $150 per share, which is the current market price. On the other hand, puts are in the money when the strike price is above the stock price because there's value to being able to sell shares for a higher price than they're currently trading for. So in this example, the 175 and 200 puts are in the money because there's value to being able to sell shares for $175 and $200 per share as opposed to selling at the current market price of $150. So at the money is pretty easy because it just means that the strike price is at or near the current stock price. So in this example, the 150 call and put are both at the money because the stock price is 150. However, if the stock price were 152 or 148, the 150 call and put would still be considered at the money because they're the closest options to the current strike price. Lastly, out of the money just means that there's no value in buying or selling shares at the option strike price as opposed to the current market price. So for calls, if the strike price is above the current stock price, the options are out of the money. For example, the 175 call in this example is out of the money because there's no value in buying shares at 175 when you can just buy them at 150 at the current market price. For puts, the options are out of the money when the strike price is below the current stock price. So let's say you're looking at the 125 put, that option's out of the money because there's no value in selling shares for 125 per share when you can sell them for 150 at the current market price. So to build on what we just talked about, let's compare option strike prices to the amount of premium that they have. So for calls, in the money options have the highest prices and out of the money options have the lowest prices. So we know that in the money calls are call options with strike prices below the current stock price. So in this visual here, SPY is at $227, which means any option with a strike price below $227 is considered in the money. As we can see, when we go to lower and lower strike prices, the call premium increases because there's more and more value to being able to buy shares at a lower and lower price. Now, on the other hand, out of the money call options are calls with strike prices above the current stock price of $227. And as we can see, at higher and higher call strike prices, the call's premium gets cheaper and cheaper. Now, the cheaper premium is represented by the fact that, first, there's no value to being able to buy shares at a higher price than the current market price of the shares. Second, a call option will only expire with value if the stock price is above the strike price at expiration. So for higher and higher strike prices, there's a lower probability that the stock price will rise to that level or go beyond it. So therefore, the call prices with higher and higher strike prices are cheaper because there's less of a likelihood of them being valuable at expiration. Alright, now let's talk about put strike prices versus the put premium. So this is going to be completely opposite to what we just saw with the call examples. So as we know, puts are in the money when the strike price is above the current stock price. So as we can see here, any put with a strike price above $227 is in the money, and the premium gets more and more expensive at higher and higher strike prices. Now that's because there's more value to being able to buy shares at a higher price than the current market price. So puts with higher and higher strike prices are more valuable. On the other hand, out of the money puts are any put with a strike price below the current stock price of $227. So as we can see here, as you go to lower and lower put strikes, the put premium gets cheaper and cheaper. Now that's because first there's no value of selling shares at a lower price than the current share price, and also at lower and lower strike prices, there's a lower probability that the put will be valuable at expiration. So for example, the 215 put has a higher probability of being valuable at expiration than the 200 put, and that explains why the 215 put has more premium than the 200 put. Alright, well that pretty much wraps up the main concepts you need to know about strike prices, so let's just go ahead and recap what we talked about in this video. So a strike price is the price in which an option buyer can purchase or sell 100 shares if they exercise the option. Now you also learned about terms such as in the money, at the money, and out of the money. So in the money options are calls with strike prices below the stock price or puts with strike prices above the stock price. And in both cases, in the money options are going to be the most expensive options. At the money options are calls or puts with strike prices equal to or near the stock price. Now out of the money options are calls with strike prices above the stock price or puts with strike prices below the stock price. And in both cases, out of the money options are going to be the cheapest options. Well, that wraps up this video on option strike prices. If you enjoyed this video, please subscribe to our YouTube channel as you'll get video alerts when we come out with new topics. Also, if you want to give us a follow on Twitter, we release new content there as well as we come out with it.